Welcome to Listen2Riches. Today, I'd like to introduce a book titled The Psychology of Finance. The author of this book is Lars Tvede, a successful investment banker, fund manager, and financial derivatives investor. He's also the author of the best-selling book Business Cycles, which establishes him as an expert in the financial world. Lars Tvede is known for his ability to navigate financial markets effectively and protect his investments. It's like having a master gambler teach others how to beat him at his own game. As a result, this book has been reprinted more than 50 times, and its global popularity is no surprise. The Psychology of Finance delves into a fundamental concept. The direct factors influencing financial market prices are the psychology and cognition of market participants. I'll break down the essence of this book into 3 parts. The first part introduces the 4 fundamental principles of financial markets. The second part discusses the most valuable information in financial markets. And the third part explores the psychology of investors and how they influence stock market fluctuations. Let's start with the first part, the 4 fundamental principles of financial markets. To illustrate these principles, let's go back to the infamous Wall Street crash of 1929. In 1929, the U.S. stock market was in the midst of a 10-year bull market. Everyone was investing in stocks, believing they would bring substantial returns. However, on October 24, 1929, the stock market suddenly began a rapid descent. In just 2 weeks, a staggering $30 billion of wealth evaporated, equivalent to the cost of World War I. This hardship persisted until July 8, 1932, when the market finally hit bottom. During those 3 years, the U.S. GDP halved, 110,000 businesses went bankrupt, over 8,800 banks closed, and 17 million people were unemployed. Even Yale University's economics professor, Irving Fisher, couldn't escape the turmoil. Once one of the wealthiest economists globally and known as the Wall Street prophet of the 1920s, he saw his $15 million fortune vanish during that economic crisis. By 1935, Fisher was forced into retirement by Yale University, carrying a debt of $750,000. Aside from Fisher, one of the most renowned economists of the 20th century, Keynes, also faced near bankruptcy during the crisis. You might wonder how the world's most authoritative economists suffered such severe losses. Moreover, after the 1929 crash, various financial crises of varying scales continued to emerge, each bearing similar tragic consequences. Did people not learn from these experiences? Perhaps there are mysterious forces at play in the capital markets that go beyond economic theory. The author summarizes 4 fundamental principles underlying these mysterious forces. The first principle is that the market leads the economy. This means the stock market serves as an economic barometer, often providing early indications of economic trends. Generally, during economic recessions, the stock market tends to decline ahead of economic indicators, while in economic upturns, the stock market often rises ahead of these indicators. Why does the market have this predictive ability? It's because investors at the forefront of industries anticipate forthcoming changes. For instance, if investors in a specific industry notice a decrease in orders and reduced demand for the industry leader's products, they may decide to sell the company's stock. These investors may be more aware of the risks facing the company than its management. Conversely, if investors observe a company with overflowing orders and high demand, they may choose to buy that company's stock. This market insight forms the basis for the rapid market responses. How long can the stock market lead the economy? According to Bruno Solnick, the first chairman of the European Finance Association, it takes approximately 6 to 9 months from a stock market trend reversal to an economic trend reversal. In other words, the stock market's changes precede those of the economy by 6 to 9 months. When the stock market experiences 6 to 9 months of growth, company sales and financial indicators begin to reflect corresponding changes. It's worth mentioning that in reality, the stock market is influenced by factors of manipulation and human intervention to a certain extent. As Lars Tvede points out, the market is not infallible. It's often influenced by emotional factors and can exhibit irrational characteristics. Now, let's delve into the second fundamental principle of financial markets. The market is irrational. In 17th century Netherlands, the wealthiest capitalists believed that tulips were a symbol of taste, and they became a craze in high society. Tulip prices soared year after year, and at the height of the craze, a rare tulip bulb was worth as much as a brewery. The prosperity of Dutch tulips attracted the attention of foreign investors, leading to a buying frenzy at even the slightest price drop. But one day, doubt crept in. Were tulips truly worth that much? Panic and a collapse ensued. Ultimately, what people faced was the harsh reality that tulips, once valued exorbitantly, became worthless, leaving many bankrupt. This tulip mania caused a prolonged economic downturn in the Netherlands, leading to a decline from its position as the world's leading empire to a shift in Europe's prosperity center toward England. This is the famous tulip mania in history. It shows that markets, driven by collective emotions, often operate irrationally and can become hysterical under the influence of people's fantasies. This collective irrationality in the market affirms the third fundamental principle of stocks: predicting long-term economic trends is impossible. This impossibility stems from the butterfly effect, which refers to how minuscule actions can trigger chain reactions. There's a saying in financial markets that an old lady in Brussels selling some bonds might lead to a collapse in the Japanese market. In other words, market developments are entirely unpredictable, with minor changes potentially leading to vastly different outcomes. People flock to stock markets, buying and selling amid greed and fear, amplifying even the smallest profits and losses and magnifying even minor shifts. While you can predict a market downturn, it's challenging to forecast when and to what extent it will occur due to the influence of subtle details on the economy. However, the market's unpredictability doesn't negate the value of economists and market analysts. Despite the unpredictability of financial markets, their research helps maintain consistency in market psychology and brings it closer to the objective world. While they may often be wrong, their value lies in providing information and guidance in dealing with irrational markets. To cope with irrational markets, traders use technical charts to identify patterns in price changes. It's worth noting that technical charts themselves are a result of human psychology. These principles encapsulate the core concepts of financial psychology, shedding light on the complex and often unpredictable world of finance and investment. The book provides valuable insights into the psychology of financial markets, offering readers a deeper understanding of the forces at play in the world of finance. This leads us to the fourth fundamental principle of financial markets: technical charts are self-fulfilling. In other words, technical charts are a result of investors' trading behavior. Let's imagine a market with 1,000 robust investors, where 900 of them are technical traders and the remaining 100 are value investors. Even though everyone initially buys stocks at the same price, when the market reaches a certain level, all 900 technical traders decide to exit, triggering a flood of sell orders and a sharp price drop. After some time, the market reverses and starts to rise, and this time, the 100 value investors remember their past experience and begin selling at the same level. In this scenario, market development depends entirely on the behavior of investors, and technical charts become a self-fulfilling phenomenon. So, I've covered the 4 fundamental principles of financial markets comprehensively. Investing is an incredibly complex endeavor, and professional investors tend to make more profits compared to the majority of market participants. This difference arises not only from disparities in financial knowledge and investment skills, but also from the information gap between ordinary individuals and professional investors. Access to valuable, genuine information is the key to making sound decisions. The second part of this content will focus on which type of information holds the most value in financial markets. According to Lars Tvede, financial market information primarily falls into two categories: news and trading information from market participants. However, Lars Tvede argues that news, in reality, doesn't possess true value. He illustrates this through several instances where market trends often run counter to news reports. For example, a business magazine might predict a drop in government bond prices, but the actual situation sees government bond prices skyrocket. Similarly, a cover story might tout stocks as the preferred investment, only to be followed by a stock price decline, reaching its largest drop ever 3 months later. Why do news reports often contradict market trends? First, people often unreasonably assume that information published in the media is necessarily accurate and reliable. In truth, public news contains ambiguous and conflicting information, including misinformation. As Clausewitz once said, most unfiltered information is false, which implies that information doesn't genuinely reflect market trends. Second, the value of news information is significantly discounted the moment it's released. As mentioned earlier, the market leads the economy, so before favorable or unfavorable news is officially disclosed, the market has already reflected people's expectations. Therefore, at the moment news is officially published, market prices often have already reached their peaks or troughs. Third, the overwhelming complexity of news information can create immense stress and lead people to doubt things they were initially confident about, resulting in incorrect judgments. In reality, the direct influencing factors on financial prices are based on the judgments and perceptions of market participants, and the media can't predict group perceptions. Thus, Lars Tvede believes that news information holds no practical value for investors and can even be misleading. Trying to profit solely by following financial news is impossible. If you wish to make money, you should pay more attention to trading information from market participants. Market participants can be divided into two categories: institutional investors and retail investors. Retail investors are typically less sophisticated players in the market, whereas institutional investors, on the whole, tend to make more profits compared to most other participants. Following their actions can help us make money. Lars Tvede mentions that institutional investors primarily fall into three categories. First, there are executives holding more than 5% of shares in publicly traded companies. Second, there are large capital holders on stock exchanges. The third category comprises financial arbitrages. At present, the trading activities of these critical market players need to be registered and publicly disclosed by regulatory bodies, and their trading patterns can be found in public information. For executives of publicly traded companies, a significant sell-off of company stock may occur because of a need for cash, selling stock early to improve their personal finances. However, it's more likely that they've become aware of issues within the company, making this a potentially dangerous signal. Conversely, if executives are buying substantial amounts of company stock, it indicates they believe the stock is undervalued or the company has a promising future. This is because executives are the individuals who know the company best. Then there are large capital holders who are generally known as major players and include state-owned funds, insurance institutions, mutual funds, brokerages, QFIs, and others. These entities are typically government-owned or large commercial institutions, and their actions can influence market fluctuations and rotations. If data shows that they are selling heavily, it means the market is likely to decline. conversely, if their sell-off only constitutes a small portion of total selling in the market is unlikely to decline significantly. Finally, financial arbitrages are often the first to detect price changes and use financial transactions to mitigate risk. They possess rich market insights and can predict price changes in advance. This ability is due to the fact that many of them have frontline experience in a specific industry, such as raw materials like iron, ore, crude oil, rubber, and coal. When they sense that the price of a particular raw material is about to drop, they may sell it in the futures market to avoid company losses. Therefore, if you notice financial arbitrages selling heavily, it's highly likely that prices will drop. The article points out that even these major players may sometimes falter in bullish markets because, while information is crucial, mentality also plays a significant role in the success of investments. We'll now move on to the third part of this content, which will focus on investor psychology and how it propels stock market fluctuations. Psychology is a hidden need and desire that often influences our actions without our awareness. Lars Tvede points out that whether professional investors or retail investors, their trading behavior is often susceptible to the influence of 4 types of psychology. First, the regretful mindset. When the stock market has already risen and you haven't entered, a strong sense of regret may well up within you and you might feel remorseful. As the stock prices dip slightly, you'll eagerly jump into the market, hoping to make up for your previous missed opportunities. This kind of regretful psychology is common in the stock market. Second, the overconfident mindset. People tend to attribute their success to personal effort rather than luck. After making profits in the stock market, some investors become overconfident, believing they possess extraordinary investment abilities. This overconfidence can lead to reckless trading, with frequent buying and selling. However, in the investment realm, frequent trading often doesn't yield stable returns. Third, the conformist mindset. This means going with the flow, being especially susceptible to the opinions of the majority, and maintaining positions and actions in line with the majority. If others are buying, you buy too. If others are buying at a certain price, you also buy at the same price. Fourth, the self-defensive mindset. When people's actions yield results opposite to their expectations, they often are reluctant to admit mistakes. Instead, they may ignore or misinterpret uncomfortable information and seek comforting information that favors them. For example, in the face of significant losses in the stock market, people may be unwilling to check stock prices, review their accounts, or accept unfavorable news, but they will eagerly chase favorable news. These 4 mindsets can influence stock market trends during both rising and falling periods. First, let's look at the rising trend. When the stock market begins to rise, many people may initially be uncertain and as a result, they hesitate to enter. However, there will always be those with foresight. Some may enter early and stock prices gradually climb. As most investors start regretting not entering earlier, they eagerly await a dip in stock prices to follow the big players' lead and buy in. In this scenario, when stock prices slightly fall, investors rush into the market, propelling the prices upward. This phenomenon catches the attention of stock analysts who advocate for more investors to join, further boosting stock prices. With more people buying in, stock prices continue to rise, and publicly traded companies find it easier to finance themselves in the stock market, investing in the real economy, thus creating a virtuous cycle. Next, let's examine the declining trend. Under the influence of a bullish market atmosphere, people enthusiastically invest heavily. However, when stock prices decline, especially when they lead to significant losses, investors endure enormous mental stress. Under this pressure, their mindsets may change within hours, minutes, or even seconds. People start believing that market prices are too high, anticipating that the bear market will persist, causing new selling pressure. Continued declines lead to more panic among investors, sparking a new round of selling. In summary, the market is influenced by people's perceptions and emotions. Apart from technical indicators, trading volume is an essential tool for assessing trends. Trading volume is genuine data that's challenging to disguise. Typically, during bull markets, trading volume is higher than during bear markets because people react differently to gains and losses. Consequently, during a bull market, trading volume increases, and during a bear market, it relatively decreases. Therefore, although some technical indicators can serve as references, market trends are mainly driven by people's perceptions and emotions. To sum up, this article first introduced the 4 fundamental principles of financial markets. It then discussed the 3 most valuable types of market information and detailed the psychological mechanisms behind stock market upward and downward trends. Despite the lessons learned from financial crises, human nature and emotions continue to lead people into crises. Lars final reminder is for people to focus more on the market's own signals rather than just listening to other investors' opinions. Alright, this book has been decoded for you. Congratulations on completing another book. Thank you for your support and attention. Please subscribe to Listen2Riches, like, and share this valuable knowledge with your friends. Let's combine wisdom with practice to achieve our financial goals and create a better future. Thank you, everyone. See you in the next episode.